So new business models in finance and lending. Let's get started. So let me kind of start this with a little bit of genesis of how lending has evolved over a period of last 2 decades or 2 to 3 decades. The way we understand lending is, in the past it has been the banks and the non-banking financial companies, or NBFCs as we call it. They have been the only players in the entire lending space. Later, 10 years ago, we saw a lot of fintechs coming in and either taking the business away from banks and NBFCs, or they started partnering with banks and NBFCs, and kind of they became part of the ecosystem. But today we are at the inflection point, and uh, basically anyone and everyone is trying to get into lending. So a lot of different terms are being coined to this phenomenon. Some people call it embedded finance, some people call it embedded banking, some people call it everyone lending or whatever, right? Or just in time lending, or terms like buy now pay later. It all means the same thing. Basically, the phenomenon is everybody is trying to get into lending. So this is what we are right now, and we can see some of those players on the right side have already gotten into it, but this is just the beginning, and the future is very exciting. uh, so that if you look at just the trends in the market, right, there are very prominent trends which personally, as a strategy guy, I have been tracking for last few years. And I can clearly see that some of those trends are driving the whole market and the way lending space is evolving, right? To begin with, the sharing economy and collaborative consumption, right? Nobody wants to own the assets today. Everybody wants to use the assets and pay for the use, right? Be it in asset finance, or be it any kind of uh, uh, high value, I would say, use of any equipment, right? Leasing was getting closer to this in the past. People didn't want to buy the assets and then take it on loan. People wanted to just lease the assets, and the ownership still continues with the either the manufacturer or with the financial institution, or whoever is the captive who's financing that particular equipment. But today it is surpassed from that leasing, and now it is getting into renting and subscription based usage of the assets, right? So that's a big shift that we are seeing. We've been seeing this shift in the past, pre-pandemic, but after pandemic it is just accelerated completely because of the new business models, and nobody has that kind of cash that in hand to kind of buy stuff and then keep it in the inventory and not use it for some time. So sharing economy is a big thing. uh, After 2008 crisis, the whole world has seen collections has become a big focus point, and I'll talk about all these things in little detail, as we move forward. But at a glance, if you see, this is how the lending is evolving, right? So we will talk about how collections is evolving in the case of bad debt management or delinquencies, and how NBFCs or banks or fintechs are playing a role in this space as well. We'll talk about some of the fintechs landscape in terms of the lending globally. We will talk about front to back, and finally the embedded finance. Uh, let's talk a little bit about what is the impact of COVID we are going through, right? We're at the fag end of the COVID pandemic. We can probably call that, if there are no more waves. But assuming that this is the end of the pandemic now, because we've seen a lot of businesses opening up again, there is, the travel is starting again, and all that good old days are coming back, right? In that context, uh, it has left a lot of impact on the businesses and the new businesses model which has evolved. They are not going to go away, right? The pandemic will go away, but what has evolved in last couple of years is going to continue, right? So one of the things is, everybody is now online, right? The whole world is online, be it the schools or the shopping malls or the medical services, legal services. Everything that you can imagine is available online today. So that's going to continue. And specifically, if you look at the lending, in the lending space, we would have the demand has gone up drastically, because now the businesses are opening up. So the pent up demand has to be driven by the lenders, and they should be able to support those kind of volumes, and quick decisioning and those kind of things are going to come up. Then there is a sizable increase in terms of the flexibility of the contract, right? The way the contracts are structured, the way the new deals are done, all that is changing, right? So that flexibility is going to remain. The demand from the consumers and the demand from the businesses is going to be always there in terms of the flexibility of the structures of the contract, the payment schedules, and so on and so forth. Uh, the decisioning and the credit lines which are being the borrower capacity assessment, right? That will get stricter and stricter, and more scrutiny will have to happen. So that continues because the acceleration of delinquency is a big risk, and that has to be tackled by the lenders in a better way, right? And finally, the margins will become leaner because the competition is getting tougher and tougher. I talked about leasing already. So this is what the impact at a very high level you can see because of the pandemic on the lending business. Now, if we move forward, I talked about embedded finance in one of my earlier slides, right? So how does this embedded finance really, present itself in the business? So one of the articles which I was reading, a very surprising data point which I found was the bank lending is slowing down at 4.4%, and it is at its slowest rate over the past 5 years, right? So this is very counterintuitive because you would think that the lending is always growing and more the pie is basically increasing, right? So what is it? Is it that the lending is reducing, or it is just that the banks who are in the lending business, they are shrinking from a lending perspective? So the answer lies in the dynamics of lending, right? A lot of new players have come in, the fintechs have come in, and the buy now pay later players, right? Like Sezzle or Klarna, Affirm, Square, which has just acquired Afterpay, right? All those companies have started coming in and now playing a big role in the lending space, and they're all BNPL as we call it, or buy now pay later, right? So those companies are trying to take away the pie. The pie is increasing, but it is increasing because of the new players, and they are trying to increase the overall reach in the market. So the age of embedded finance has really started. Now, there are many definitions of embedded finance in public domain, and all are right, right? But to me, embedded finance simply means seamless user experience, right? This experience is delivered at the point of interaction for the consumer, be it a consumption of the service or purchase of a product, right? Uh, so the days have gone when the customer goes to the banks and the financial institutions for availing the services. Today, the customers are kings and they behave like one, we must say, right? So banks need to go to the customers in a virtual way and provide a service like loan, credit, or payments for that matter as well, at the time of customer needs it and at the point where customer needs it. So bank is becoming like a commodity or a utility today, and especially in the retail and consumer space. So the delivery of this consumption and financial services embedded within overall user journey will expand the scope and the reach of the banking and even insurance for that matter. So some of the interesting data points around this is, there's a massive new opportunity for lending in the form of embedded finance, as I talked about, but it offers an addressable market opportunity estimated to be around 7 trillion in the next 10 years, which is the twice of the combined value of world's top 30 banks today, which is the kind of estimate that has been put together by the analyst, right? And there are many examples of embedded finance around us today. We are using the cab booking, the Uber, Ola, Grab. They're all doing embedded payments, right? Or in the lending space, a lot of players are doing finance at checkout. I talked about Klarna and Afterpay and those players, right? So they're all doing BNPL, right? Which is nothing but finance at checkout. At the time of checkout, the customers are able to buy white goods or brown goods or electronic items, and they are paying, later and not immediately, or not using the credit cards, for example. Telcos are offering this kind of services as well, right? So this is very unique, like 0% interest. You can just have a handset. In e-commerce space, I talked about Klarna and stuff. So in each space, you would find there are players who are getting into now, and I would say the fortune favors the brave. The time is to act now, for the lenders and for the financial institutions to be able to capitalize on this particular opportunity of embedded finance. So that's a big area that we have to watch for, and fintech should really be getting into it to tap on this. Now, what is the counter argument to this, right? I just came across this article very recently, and a very interesting one. So, on one side, we are saying BNPL or buy now pay later is a great thing, but on the other side, there are efforts in some of the countries, and this is in the UK, if I'm not wrong. It is saying say buy now to buy now pay later, right? And why? Why is that? That's because finally you have to pay what you are buying, right? It's not going to be free, and there are charges, there are hidden charges, which is not very transparent to the users or the consumers. Many times the price of the asset or whatever is the service that is being taken on buy now pay later is actually embedded, that the fees is embedded within the price itself, and the BNPL users are not very sensitive to price. So effectively a study has proven that the BNPL consumers end up paying 20 to 80% ARR, right, which is huge. And in case they end up defaulting on a particular payment, the restructuring fee or the charges, the penalties are huge. So that ends up in a not a great deal from a consumer perspective. So some consumer protection bureaus are trying to push the consumers away from BNPL model. But that is the counter view of this. I'm sure the regulators will catch up, and there will be some way of handling the situation, and things will change sooner or later. Now, let's look at the fintechs who have entered this space, right? I talked about some of them like Affirm and Klarna and Afterpay in the past, but there are so many players, right? If you look at the global marketplace, uh, so overall fintech landscape within that, if you focus on the lending and finance, we find a few, and if you just focus further, there are 100 plus fintechs that we have studied, and there's a typical pattern that we can see. The fintechs are organized in different ways, right? There are fintechs which are just in the marketplace approach, where they are trying to do point to point connection between the consumers and the suppliers, all in auto finance as well as in SME lending, or even unsecured consumer loans, which is a P2P platform like Lending Club, right? Then there are decision engine and scoring engines which are evolving, and they are just trying to do scoring based on the social score, the LinkedIn score, or based on your buying behavior on the platforms like Amazon or Alibaba, right? So those behaviors are giving some scores. So the decision engines are the new age decision engines, which are not just the credit bureaus and decision. They are like something credit bureau plus plus. So there are fintechs trying to acquire this space. There are online loan origination platforms for unsecured loans. They are doing a lot of user experience thing, and doing it in a very nice way, but they are actually working with the backend with the banks or some kind of cloud based loan servicing platform, which is the last one here, right? And then there are mortgage loans origination platforms, virtual banks, and a whole lot of the different models, right? But if you really look at all these 100 fintechs, and we've kind of studied this, it tells us that there are typical categories and patterns within which they operate. So that's the space to watch for. Now, from a collections perspective, the past has been sending out letters. Of course, the regulations has to be met. How many times can you send letters or emails or phone calls? But taking care of all those regulations, the only way to reach out to the customers in the past was letters, emails, and phone calls. It has changed over a period of time. Today, we have mobile apps, online portals, social media, and automated chatbots, right? But it is changing even further, right? And especially after the pandemic, uh, I have seen personally that there are a lot of players who are trying to provide AI and ML based collections. And what I mean by that is the potential delinquencies are being predicted upfront based on the behavior of the customer, based on attributes of the customer which are available with the lender, and a similar persona of the customer is available in the past. From the production data, they're able to predict that this particular customer might default in a month or so, right? So that prediction is coming in, and hence uh, the potential defaulters are able to be tackled. The lenders can tackle those in a better way. The collection strategies are being defined by the machine learning, right? So what is the best way? The champion challenger, which was being done manually in the past. Now the challenger is being proposed by the machine learning algorithms, and that challenger can be put to test in production for some time. And if that happens to be better than the champion, then the champion is overridden by the challenger, and so on and so forth. So that champion challenger through machine learning is giving a new paradigm shift to the whole collections, right? And all this has to happen while keeping the costs low, because if you increase the cost, it is going to be a burden on the lender anyways. So this is full automation, the chatbots, the reaching out through bots, reaching out through automated reminders, proactive tracking, and the strategies which are consuming lesser resources from a manpower perspective is reducing the cost as well, right? So this is a boon for the lenders, and even the consumer, for example, they are happy with it, because at times they don't want to make a phone call for restructuring my payment or making a promise to pay. They are happy with just chatting with the bot and kind of changing the instructions and making a promise by talking to the bot, because bot is available 24 by 7 and 365 days, right? You don't have to have a waiting in the queue on the phone and so on and so forth. So that is actually evolving right now in collection space, and it is very, very interesting how it is changing in the current market, right? I talked about the bots. This is one of the surveys that was conducted, and the potential is huge. The chat bot today is just a table stake. It is not something fancy, which used to be the case like 4 years ago. But it has become like everybody has to have a bot. If a lender does not have a bot facility, the chances that the borrower would want to turn down to that lender and go to somebody else who has got a better customer experience or customer service, right? So chatbot becomes part of the ecosystem, and it is all driven by the AI/ML again. Some of the use cases which we have seen in using chatbots, which customers like to use, are on this slide. But the most frequently used are the payoff codes, last five transactions, or making a promise, as I said in the past, or changing my preference of communication. By just going to the bot, I can just say that this is my new phone number. I get a OTP, I change it, and then I am able to change the instructions to the lender. So that's the kind of interaction that we're talking about here. Now, augmented reality is one more area which typically in the lending space wasn't envisaged in the past. But we've seen that even AR is knocking the doors, and it is basically, there are a lot of opportunities. There are a couple of use cases on this slide, but basically a collector, right, going door to door in certain geographies and trying to get collection of the recoveries, or whatever is outstanding through cash, is able to just point a device on the car. If it is a car financed, right, that device will just show the outstanding amount, who the vehicle belongs to, and the collector is able to collect that money, record that money there and there itself, and that payment happens, and then basically the updated amount comes here, receipt gets printed then and there, and this is kind of without entering anything, just pointing the device is able to do all that interactions. The other thing is, in case of indirect lending, there are fleet inspections that is happening using the AR. Sometimes trade-in use cases where the old car is being traded in with the new car at a dealer's place. The AR is being deployed there. So that's an interesting area as well, but very, very little adoption at this stage. Uh, the next important topic is the whole servitization, right? Using everything as a service, which I talked about earlier, usage based rather than ownership based, right? So, car as a service. Now, a lot of manufacturers, in fact, all of them have started this service by now. Uh, uh, so instead of taking a particular car on lease, there's a fleet of car which is available. I just pay $700 a month, and then I can choose based on my mood, based on my uh, week schedule. Like if I'm going to office this week, I would probably go for a sedan, but if I am on a vacation, I'll probably go for a SUV, right? So I can actually exchange my cars week on week, and just pay monthly whatever amount, X amount, in this case $700 being shown on the PPT, right? But it could be depending on what kind of membership that you enroll for. You could just start using the asset without worrying about the all those taxes and the maintenances and all kinds of fees. Nothing you have to do, just pay once a month, and that's about it. So that's the servitization in the car manufacturing. But it is happening all over the place, right? So if you look at how heavy industries, heavy equipment like HVAC systems, forklifts, right, or manufacturing equipments like boilers, and in hospitals, uh, the medical equipments. All of that is now available. The manufacturers are giving it on usage based, right? And how is it done is very interesting, right? So first of all, let's look at the need of it, and then I'll talk about exactly how it is done. So according to one research, it was found that 9 out of 10 times the the asset ends up in the either underutilized or overutilized, right? So it's very difficult to guess at the beginning of the lease contract that what is going to be my um, usage pattern, right? And hence either customer ends up paying more or less, right? And one of the parties, which is the lesser, or the customer gets is at loss. So that can be handled if you can monitor the asset on a regular basis, right? So this is the exact problem that is getting solved by tracking the asset on a regular basis, right? So uh, typically each equipment manufacturer is putting a port on their machine where you can install an IoT device, an Internet of Thing, right? And that device is able to transmit the usage data, the performance data over the internet or over the telephone network, and that gets into the lender's system, right? And those systems are able to now track the usage and able to charge for exchange or overage, or able to penalize the customer if the customer moves the, let's say in this case, max speed, or changing jurisdiction area, and so on and so forth. So operational requirements as well as the financial requirements can be tracked and triggered using IoT based integration with the lending platforms. And technology offers that today because of the IoT being available. So this is how typically the equipment finance and the asset finance is trying to leverage the technology to do the tracking of the assets on a regular basis, and provide a better experience, and being the fair game from both perspective, lender perspective as well as from the user perspective. So that's what I wanted to cover today.
Fantastic. Thank you. Thank you so much for your presentation today, Unmesh. I can see you're super passionate about that. I feel like you could probably talk about it for hours. That really shows through your presentation and your speech. So we've got 5 minutes left now for a short Q&A. So I've just got some questions here, kind of off of the back of your presentation. So I was kind of wondering, what are some of the key drivers that enable financial products and services to be embedded into these like non-financial activities, other than maybe a few of the things you were talking about?
Sure, that's a great question. So that thanks for asking that, because that gives me an opportunity to talk about something which I probably missed in my 20 minutes of talk, right? So the question is, this sounds simple, right? The idea science sounds very simple, but not like a unique idea today as well, right? So, but that's precisely the reason that the adoption is so fast for the embedded finance. Now, what is the trigger for this sudden wave of adoption, right? And the answer lies in technology. As I said earlier, the IoT is one of the triggers, right, which allows the tracking of the assets on a regular basis, right? So that is in the servitization space. But in the embedded finance space, cheap hardware and the network connectivity has led to cloud-based consumption, adoption of smartphones, availability and affordability of high-speed internet, right? And the spread of this technology across the globe, not just restricted to the big cities, but even getting into the smaller tier 2, tier 3 cities. So these factors has helped explode ideas like embedded finance, and will continue to grow in coming years rapidly, is what I believe.
Fantastic. And just another question, hopefully we can squeeze in here. I loved when you had that slide on your presentation about all of the fintechs, and I wanted to ask a little bit about kind of partnerships. So like, looking ahead to the future, what is the role that partnerships will play in this new and evolving world of embedded finance? Will the role of banks change in this new ecosystem of banking?
Yeah, that's a very, very interesting I would say, situation that we are in. So once again, as I described earlier, right, the banks and these services are increasingly becoming commodities or utilities, right? So banks will work more and more with fintechs and service providers to the end customers and deliver banking through these players, right? Which are essentially the partners for the banks. Now, banks of the future will have to be more of a data and analytics driven and proactive selling of those services, rather than consumer reaching out to the banks for services. Now, this changes the whole paradigm for the banking, and for this is for the good, right? Uh, One thing is for sure, that the times ahead for banks is very exciting. Consumers, banks, service providers, partners, and banks all have to collaborate and work together rather than competing. Because if you collaborate, we are going to make this world, better place to live. Because the overall experience of everybody, the standard of living, everything is going to go up, right? So that's how I am seeing this space evolving, rather than competing with each other, which was the beginning of fintech era. But now I see that they are able to coexist and work together in the partnership mode.
Fantastic. And that just about wraps up our session here today. So I just want to thank you so much, Unmesh, for your time. I really appreciate it. And like I said, I mean, a super fascinating and passionate session from you today. So I really appreciate it.
Thanks. Thank you so much, Emily.